welcome to the massive open online course on money and financial markets on determinants of the structure of interest rate. First of all, we introduce to the concept of interest rate. That means, what do we mean by the word interest rate? Interest rate basically is actually an equilibrium interest which is satisfying the objectives of two economic agents, namely the borrower and a lender, in any financial engagement or in any financial market. So this actually takes care of the concepts of borrowing, where we take care of the investor's point of view, and the lending, where we take care of the lender's or the saver's point of view in the financial market, and their engagement depends upon the extent of a numerical measure of the rate of interest. So, interest is the payment for the services of capital. As we go by the factors of production, land, labor, capital and organization, every factor of production has a respective price. For example, there is a rent to the land, wage is the price of the labor, profit is the price of the organization, and most importantly, interest rate is the price of the capital, where the capital here refers to any form of funds or any form of investment which is taken up. So whenever we actually consider on the word investment, we refer to a particular market, just like we have a demand and the supply for the market of goods and services. Here we have the market for loanable funds. That means the funds which can be available from the borrowers and from the lender's perspective. So this takes care of the interest rate as one of the mechanism which equilibrates the interest of both the borrowers and the lenders. So we define interest rate as also the price of hiring capital, where capital is one of the most important factor of production, which takes care of the physical capital, for example, machinery, equipments, which are utilized in the production of the goods. And thereby, when any investor wants to start up a business, he wants to borrow capital to purchase this type of assets. So this borrowing takes care of through a mechanism which is called the interest rate. So thereby the term loanable farm market comes into existence, which is a sufficient condition for the interest rate to function. Like in the demand supply of the final goods and services, we have the common measurement, which is the price, which act as an invisible hand. Similarly, in the market for loanable funds, we have the lenders and the savers, where the rate of interest act as an invisible hand to equilibrate the mutual interest. So taking care of the concept of the interest rate, we can now define the supply and the demand side of this loanable funds market. So this gets back to the payment that is made to the supply of the loanable funds. So basically, by the supply of the loanable funds, we refer to the generation of savings in an economy. So savings can be both or two ways. Either it can be generated from the individuals, which is called the private savings or the domestic savings, or it can be done from the government as the public savings. So total level of resources generated in the economy comprises of the generation of the total savings, which is one of the major important parameter of the loanable funds, and it also explains how the loanable fund to function, which is on the supply side. And at the demand side, we have the investors who actually want to demand for the funds, and thereby the equilibrium takes place through a common mechanism, which is none other than the rate of interest. So the payment to those who supply the loanable funds in the market is called the market rate of interest, and this is actually expressed by the percentage of the funds which is actually borrowed. On the other hand, when we take care of the loanable fund market, we also introduce the word entrepreneur, because this entrepreneur actually takes up from the investor's point of view, who wishes to invest in the capital and the machineries, and thereby utilizes in the process of production in order to generate the return on its investment. So firstly, it borrows at a certain rate of interest called the cost of borrowing, and finally the return that is being got, which is the return on the capital, which is from the lender's perspective. So the demand side belongs to the investors, and the supply side belongs to the lenders, And this actually defines a market where the demand and the supply forces interact, and thereby they determine the interest rate determination, which is the equilibrium interest determination where both the demand side and the supply side interacts. So interest rate has many definitions. Among them, the most important definition lies here, that it is the price of the hiring capital, where capital is basically the form of the machinery or the physical equipments which takes place. This also takes place as a concept of the borrowing from the investor's perspective. Now we move on to the determination of the equilibrium interest rate. So in order to define the equilibrium interest rate, we define the functions one by one. First of all, we refer to the function on the demand side, where we say that from the demand side we mean the investor's point of view or the investment function. So here the investment function is denoted by capital I, which is equal to small f, which is a function of R. R stands for the rate of interest, and we find out that this f dash is less than 0, which means that if the rate of interest is on the rise or the cost of borrowing is on the rise, then the inducement to invest will be on the fall, or it will be demotivating for the investors to invest. That means an investment function is always inversely related to the rate of interest, which makes the demand to be downward sloping or the investment curve to be downward sloping. Next, we move on to the supply side. By supply side, we mean the lender's perspective or the generation of the savings, where higher the rate of return, more will be invested or more will be funded or more will be supplied. So thereby we introduce S, which is the savings, which is actually the function of R. We are introducing the alphabet H because F is already there in the investment function. So we are denoting by a separate alphabet H, which is a function of R, which is R is the rate of interest again, but it is the rate of return now. In the earlier function, that was the cost of borrowing. And here we find out that there is a direct relation between R and S. That means H dash is greater than 0, which means higher the rate of return, greater will be the motivation for the lenders to lend out, or more funds will be supplied in the market. So the equilibrium condition says that the saving and investment must equalize together at a common interest rate which satisfies both the interest of the investors as well as of the lenders. So this gives us a graphical exposition where rate of interest is plotted on the y-axis, and here the funds, which is referring to the demand side and supply side both, is plotted on the x-axis. We have the investment curve, which is downward sloping, because with the increase in the cost of borrowing, the level of investment will fall. But the savings curve is upward rising, because with the increase in the rate of return, more inducement to savings will take place or more funds will be supplied. It is observed that a particular rate of interest, which is R star, where both the curves are intersecting together, and that is at the point E. That means only at the point E, both the lenders and the borrowers, they are actually satisfying their mutual interest, and the loanable fund market is attaining equilibrium at a common interest rate, which is R star, where the market actually clears. And this is the equilibrium level of funds which is being generated. So if we take any rate of interest above R star, we find out that there is excess savings. So that pulls down the interest rate below to attract the borrowers. Because to attract the borrowers, the cost of borrowing has to come down. Then only they will start investing. And on the other hand, any rate of interest below R star will make excess investment, which makes the lenders will take the advantage of raising the rate of return, because they will take the advantage of excess demand which is generated by the investors. But finally, the R will be settled at R star, where both the curves will intersect and the equilibrium will take place. So this gives us to two important disequilibrium conditions where we have excess demand for the funds. Definitely the rate of interest rises, because this is where the lenders are at advantage, because they will take the advantage of the situation of making the interest rate to rise, the rate of return to rise, because the investors are desperate to invest. And on the other hand, just vertically opposite, we have the case for excess supply of funds, which means that the rate of interest will fall, and that means that there will be more and more motivation for the investors to come up because the cost of borrowing is on the decline. And finally, at equilibrium, we can observe that saving and investment are equal to each other, which occurs at the point of intersection. So from the demand side, we define the investment function, which is given by investment as a negative function of the rate of interest, R. From the supply side, we have the saving functions, which is an increasing rate of interest, which means a positive function of the rate of interest. And finally, at the equilibrium condition of a loanable fund market, we have saving and investment to be equalized. So now we move on to different types of interest rate that prevail in an economy. First and foremost, the interest rate that comes up in a plain and simple words is the nominal interest rate. That means whatever deposits we make in the banks or in financial institutions, we get a return on our saving deposit, for examples, and the return that we get is a nominal rate of interest where there is no adjustment with any cost of living or inflation. So the nominal interest is the payment for the use of money as capital when there is neither inconvenience, risk, or any other management problem. That means the money is not kept in idle cash balances, but the money is invested in any financial market, which gives me a rate of return, and that is what we mean by nominal interest rate. The second one is very, very important for policy making and for evaluating the economic performance, which is none other than real interest rate. Because the real interest is always adjusted with inflation. For example, if the nominal interest rate is 10% and the inflation is 8%, then the real interest rate is only 2% because it is 10% minus 8%. So always the inflation component is thereby adjusted in the real interest rate, and thereby the real interest rate takes the actual picture of the economic performance. So real interest rate is the total payment which a lender gets from the borrower, whereas the net interest is just one part of the gross interest which is paid exclusively for the use of capital. So when we talk about the real interest, an added factor is inflation. Net interest is just taking care of exclusively use of the capital, but inflation is not a counterpart in it. We proceed further to other types of interest rate also prevails in the economy. Among them, the third type is fixed interest rate, which remains fixed throughout the fixed rate term of 2 to 5 years, like in fixed deposits or any other deposits where the rate of interest is fixed for a certain period of the tenure of the bond or of that financial instrument. An annual percentage rate is the total cost of the loan, including both the interest rate and any other associated fees, which is also charged annually. So this is another type of interest rate which takes care of interest rate and also other processing fees are included, which are basically taken up as the total cost of the loan. Among the other types of interest rate, we also have the prime interest rate. The prime interest rate is the rate of interest set by the banks for their best customers, which means it would be the rate at which a commercial bank would charge to their most financially strong customers, such as large profitable corporations. So there will be a filtering of the customers takes place, and they identify the most promising customers, and thereby the rate of return is raised for them, which comes under the prime interest rate. So prime interest rate is not for the masses, but for the selected few. Next, we have a discounted interest rate, which is basically being done to provide a comfort zone to the borrowers, that is a rate lower than the lender's standard variable rate, when the bank will offer from a promotional period of time, or when any new instrument is being launched for a promotional period, this type of interest rate is being offered. And this can be an incentive to encourage customers to borrow money or to take out a loan from the bank. This also happens when educational loans or any kind of housing loans or vehicle loans come up. For a promotional venture, this type of discounted interest rate also comes in play. This is also applicable for the small borrowers and also for the self-help groups and also in the agricultural sector in most of the times. Next, we have the simple interest, is a type of interest charged on the principal or the initial amount of the money borrowed. That is how we take up the simple interest rate. It's not compounded, and its interest rate is not charged which is applied to the other loans. It is just done on the principal amount. So taking care of all these varieties of the interest rates, we can come up with a question in this regard. Like we have the real interest rate, which is adjusted with the level of inflation because it measures the economic performance over a period of time, whether the economy is in a progressive mode or it is in a regressive mode. Nominal interest rate is just the interest rate which is obtained from the deposits without adjusting with the cost of living. Fixed interest rate is actually fixed for the tenure of the term of the financial instrument. Prime interest rate is targeting the promising and the most profitable customers of the bank. Discounted interest rate is for a special purpose which can be done on a promotional venture or to any kind of priority sectors of the economy in order to make them more incentivized to take loans. And simple interest rate is done on the principal amount of it. Now we focus on the determinants of market interest rate. There are namely 5 determinants. They are economic conditions, bank rate, open market operations, cash reserve ratio or CRR, and supply of money. We will take them one by one and explain how it affects the market interest rate. The first determinant refers to the economic conditions. By economic conditions, we mean the periods of business cycles, mainly the periods of prosperity or the periods of recession or depression. Here, the interest rate have a tendency to move up and down with the changes in the volume of the business activities. So this is making the interest rate to be more volatile, unstable, and sensitive to the market fluctuations. In the period of rapid economic growth, business firms require large amounts of capital to finance increased requirements of its working capital and fixed asset. That means whenever we talk about the period of the prosperity or the booms, when the demand is actually on the high, at that point of time there is always excess demand from the investors or the borrowers, and they have a natural tendency to pull up the interest rate, and also it affects the inflationary phase. So the business demand for the borrowed funds combined with the increase in the consumer borrowing put an upward pressure on the interest rates. So interest rates respond to this rise in the demand in a positive manner, and thereby the interest rate always has a tendency to rise, which is called interest rate inertia in an economy. However, the opposite case, when there is a depression, always there will be excess supply of the funds, investors' confidence would be declining, and at that point of time, interest rate will always have a downward pressure on it. So based on the economic conditions, interest rate will respond, and thereby fluctuations in the interest rate will also affect the other economic parameters like the inflation, like the exchange rate, and further it also affects the GDP of a nation. The second important determinant is bank rate. So by the bank rate, we mean that bank rate is the rate at which central bank of a country provides loans to the commercial banks. So this is one of the most important instrument of the quantitative credit control measure of the central bank, which can be both expansionary or contractionary. So in terms of an expansionary monetary policy, bank rate is always on the fall because always it becomes more comfortable for the commercial banks to lend out from the central banks. So central bank releases more funds and thereby at a lower level of bank rate. But on the other hand, during the contractionary monetary policy, bank rate is intentionally raised high so that the liquidity is being checked and thereby less amount of loans can be made to the commercial banks by the central bank. So through the change in the bank rate, the central bank can influence the creation of the credit by the commercial banks. So that means when we refer to the credit creation, we basically refer to how all the banks are aligned in the process of the generation of the money supply, where bank A lends to bank B lends to bank C, and this process is a never-ending process. But this process will gain momentum if the bank rate is on the fall, because this refers to a credit multiplier. And the strength of the credit multiplier depends upon the bank rate, which is called the reserve deposit ratio. Because if the reserve deposit ratio is on the fall, then the multiplier will become more strong and greater amount of money supply will be generated. But this is actually taken up as one of the expansionary monetary policy of the central bank. But if the contractionary takes place, then definitely the credit accumulation will be on the fall, and at the end of the day, there will be less credit creation. So when the central bank raises the cost of borrowing, the bank rate would rise, and if the bank rate is raised, then commercial banks also raise their lending rates. Because with the rise in the bank rate, the commercial bank also will try to adopt a more stringent monetary policy, and thereby the lending rates will be on the high. So this is how the bank rate also affects the interest rate, where inflation also plays a very, very important role. And that is how the bank rate, along with the other instruments like the repo rate, like the statutory liquidity ratio, these are all the quantitative credit control measures of the central bank. They also influence the interest rate turn by turn. So bank rate is an effective measurement or determinant of interest rate. Bank rate is also referring to the issue of the cost of borrowing. So that means when the rate of interest charged by the commercial banks is high, businessmen are discouraged to borrow more. That is what is explained by a contractionary monetary policy. That means whenever the interest rate rises, it means cost of borrowing is on the high, which actually demotivates investment tendency or investment propensity. It would trend to contract bank credit and would result in the reduction of aggregate demand for money. So this would reduce the prices, check inflation or rising price. So when we talk about the demand pull inflation, where too much money is chasing after too few goods, during those times, the central bank adopts contractionary monetary policy by raising the bank rate and making the loans to be squeezed such that less amount of credit is available in the hands of people. So at the end of the day, finally the prices are being mitigated or prices are being controlled and inflation is somewhat checked. So on the other hand, if the bank rate is lowered, then the Reserve Bank encourages or induces the commercial banks to borrow more funds from it so that more amount of liquidity flows into the economy, circulation of the money is on the rise, and thereby more credit is available to the common man. So this occurs whenever the RBI or the central bank of any country adopts expansionary monetary policy. So both the dimensions are affecting the interest rate, and interest rate respond to that in a proportional manner. That means with the rise in the bank rate, the interest rate also rises. With the fall in the bank rate, the interest rate is on the fall. So they actually move equiproportionately in an economy. Next, we move on to the open market operations, which is another function of the central bank which also affects the interest rate. The open market operation means the purchase and the sale of securities by the central bank of the country. So whenever people have excessive of credit in their hands or more amount of money in their hands, then the central bank sell the securities so that the individuals can purchase them and the money gets locked. On the other hand, it buys the bonds from the people by borrowing when there is a period of contractionary monetary policy. So the sale of the securities by the central bank leads to contraction of the credit, and purchase of the securities that leads to credit expansion. So this basically takes place whenever the sale of securities takes place by the central bank. On the other hand, when the economy is in a grip of depression, purchase of securities by the central bank from the open market is called for, because the central bank will pay the price of the securities to the sellers, which are generally the commercial banks. That means by open market operations both ways, by selling the asset as well as the purchase of the asset, the interest rate may be regulated because interest rate is controlled via the inflation measure. So interest rate and inflation are equiproportionate to each other, and that is also being supplemented by the open market operations. Moreover, under open market operations, we can see that if the quantity of cash at the disposal of the commercial banks go up, they can provide more credit to the businessman. So this basically takes place under these operations, that more amount of credit is available to the economy, And as a result of that, this will induce them to spend more. That means aggregate demand of the economy will rise and the depression can be checked, or this can address to the problem of recession. On the other hand, during inflation, the central bank sells the securities and contracts the money supply. So the contractionary monetary policy is adopted when people are having more of cash in their hand. So by selling the securities, they can purchase the securities, the individuals, and their money can get locked and cash can get locked, and that is what is being done. And interest rate move accordingly. Next we have the CRR, which is actually called cash reserve ratio. So a cash reserve ratio is a fraction of the total deposits of the banks which are required to be kept as a deposit with RBI. That means every commercial bank needs to maintain a significant proportion of their deposit with the RBI, which is commonly called statutory liquidity ratio, which is called the cash reserve ratio. So when RBI wants to contract the credit or lending by banks, it raises the CRR. So whenever the CRR is raised, RBI adopts contractionary monetary policy, and thereby the control of the money supply takes place, and that is how the credit control is being meant for. But on the other hand, when RBI wants to increase the availability of the credit, that means when RBI wants to expand because of a deficiency in aggregate demand or during the period of prosperity or boom, then it lowers the CRR and adoption of expansionary monetary policy takes place. So that is how the cash reserve ratio affects the interest rate. Then we have the supply of money, which is basically the direct function from the supply side of the money market is to obtain and also to maintain a stable economic growth with low rate of inflation. So for a safe and a sustainable future, always the objective of the monetary policy is to achieve a consistent economic growth over time so that the inflation rate can be controlled. So if the supply of the money grows faster than the needs of the economy, then obviously the nominal rate of interest will rise, and this will also lead to increase in the rate of inflation. That means we can see that if the supply of the money grows in a consistent manner, then nominal interest rate will be rising, but also inflation also will be rising. That means rise in the money supply will add up to inflation, which in other way will also add up to the rate of interest, because rate of interest and inflation are actually equiproportionate, which means 1% rise in the nominal interest rate will result to 1% rise in the rate of inflation. What are the determinants of interest rates, which are namely as economic conditions, which are different alternative phases of business cycles? Bank rate, one of the most pertinent quantitative credit control measure of a central bank. Open market operations, buying and selling of securities. Cash reserve ratio, and the supply of money, which is considered as injection of the monetary system or the credit availability. This boils down to the summing up of the discussions on the determinants of the interest rate, where we introduce the interest rate as the cost of hiring capital or the cost of borrowing from an investor's perspective or the rate of return from a lender's perspective. Then we have the types of interest rate, which can be real, nominal, prime, discounted, or it can also be fixed, or it can also be net. Then we have the market of interest rate. That means a market exists which is none other than the loanable fund market, and this loanable fund market interacts the demand side and the supply side, where the equilibrium interest rate is being determined from the investors and from the lender's perspective. And the determinants of the interest rate thereby refer to most of the monetary instruments along with the economic conditions. And that is where the determinants of interest rate keep on changing depending upon the economic conditions where a safe and a sustainable future is warranted for. Thank you.